$5 billion liquidated in 48 hours. The headlines scream panic. The charts bleed red. Retail investors flee in terror. But here's what they're not telling you. This isn't a crash. It's a calculated transfer. While algorithms force sell at $75, institutional money is accumulating at levels unseen since 2008. The mechanical storm ends in 14 days. And when it does, the truth behind this crisis will shock even the most seasoned traders. What happens next could redefine wealth in the commodity markets, but only if you understand what's really happening. Welcome to Currency Analyzer. If you've lived through enough market cycles to recognize when something doesn't add up, if you remember when financial news actually informed rather than panicked, if you value analysis over noise, then you're in the right place. Before we dissect this $5 billion mechanical illusion, do me a favor. The way you'd bookmark an important document in your study, hit that subscribe button. Not for algorithms, but because strategic economic intelligence shouldn't be buried under sensationalism. And tell me in the comments, where are you watching this from? What's your local time as this silver story unfolds globally? Now let's expose what Wall Street doesn't want discussed. It is Thursday, January 8th, 2026, and the silver market is bleeding. At this precise moment, the spot price of silver stands at $75.62 per ounce, down $8 from Tuesday's historic close. This represents a brutal 2.9% decline in a single trading session. The financial media is calling it a crash. Retail investors are panicking. Social media explodes with warnings of collapse. But the professional traders on Wall Street are not panicking. They are calculating. This is not a crash based on economic fundamentals. This is a mechanical liquidation event. Understanding the difference could mean the difference between profit and loss, between strategic positioning and emotional surrender. In 2025, silver experienced a historic rally, surging over 160% throughout the year, climbing from the low 30s to a peak of 83.62 just 2 days ago. This explosive performance created a problem, not for silver itself, but for the massive index funds that hold it. These funds track benchmarks like the S&P GSCI, a commodity index that monitors 24 different raw materials. These indices have strict rules, legal obligations written into their prospectus documents. When one commodity becomes too large a percentage of the portfolio, the fund must sell it, not because the commodity is failing, but because it succeeded too much. This is the paradox of index rebalancing. The best performer gets punished for its own success. Analysts at TD Securities have calculated the numbers. 13% of the total open interest in COMEX silver futures must be liquidated over the next 2 weeks. That represents approximately $5 billion worth of silver contracts being dumped onto the market without regard for supply and demand, without consideration for geopolitical events, without concern for industrial consumption trends. Pure mechanical selling, algorithmic, emotionless, mandatory. Here's the critical distinction. This $5 billion represents paper contracts, not physical metal. The actual silver sitting in vaults around the world has not changed. The bars of fine silver in London, the coins stored in private depositories, the industrial stockpiles held by manufacturers, none of that physical metal is moving. What is moving are financial derivatives, contracts that give the holder the right to silver but not the silver itself. The gold market provides the perfect contrast. While silver plummets 2.9%, gold trades nearly flat at $4,156.98, up just 0.1% for the day. Why? Because gold did not surge 160% in 2025. It rose steadily but did not trigger the rebalancing thresholds. This divergence reveals the truth. Today's silver decline is specific, targeted, mechanical. The gold to silver ratio currently sits at approximately 58 to 1. Traders who understand this ratio are not panicking. They are watching, waiting, calculating entry points, because they know this ratio is temporary, artificially widened by the forced selling. On the technical charts, the signals are clear. The relative strength index on the 4-hour time frame has dropped into oversold territory. Below 30, a mathematical signal that selling pressure is reaching exhaustion. Support levels are being tested at $75, a psychological barrier where algorithmic buy orders typically cluster. The professional money managers understand the timeline. This rebalancing is front-loaded. The majority of the $5 billion liquidation will occur in the first 48 hours. By Monday, the worst of the mechanical storm should be over. And when the selling pressure exhausts itself, when the last mandated contract is liquidated, the market will return to fundamentals, to supply and demand, to geopolitics and industrial consumption. This is the transfer mechanism from weak hands governed by legal mandates to strong hands governed by strategic vision. The question for every investor is simple. Will they be among those who panicked and sold at $75 or among those who recognized the mechanical illusion? Because what comes next has nothing to do with index rebalancing and everything to do with the global chaos unfolding beyond the trading screens. While traders in New York stare at red numbers on their screens, a very different kind of transaction is occurring in the cold waters of the North Atlantic. United States naval vessels have just intercepted 2 oil tankers carrying Venezuelan oil. One of those tankers was flying a Russian flag, a Russian-flagged vessel seized by the United States military in international waters. This is not a headline from 1962. This is happening right now, January 8th, 2026. While the financial media obsesses over index rebalancing, a far more dangerous game is unfolding, a game of resource control, strategic metal dominance, and the weaponization of commodity supply chains. President Trump has issued warnings that read more like declarations. Colombia has been labeled the sick man of Latin America. Military action is being openly discussed. The United States is moving to control Venezuelan oil sales indefinitely. Venezuela holds the largest proven oil reserves on the planet, larger than Saudi Arabia, larger than Russia. And the current administration has made a strategic decision. Those reserves will be controlled by Washington. But here is where the silver market enters the equation. Every time a tanker is seized, every time a military threat is issued, a wave of capital floods into safe haven assets. Gold, silver, precious metals that cannot be frozen by executive order or seized by naval blockade. This is the safety net beneath the silver market. While $5 billion in paper contracts are being mechanically liquidated, institutional buyers are absorbing every ounce. Not because of technical analysis, but because of geopolitical reality. The involvement of a Russian-flagged vessel brings a nuclear dimension to the crisis. Moscow is now directly implicated as a party whose commercial assets have been physically seized. Silver is not just a monetary metal, it is a strategic material. 50% of annual silver production goes into industrial applications. The guidance systems in modern missiles, the circuit boards and radar installations, the conductive elements in advanced weaponry all require silver. The United States has renewed interest in Greenland, specifically targeting its vast deposits of rare earth minerals essential for high technology manufacturing, the same technology sector that consumes over half of the world's silver supply. This is resource nationalism in its purest form. Nations are competing for physical control of finite materials. When military assets are deployed to secure commodity flows, when supply chains become matters of national defense, the value proposition of holding physical precious metals fundamentally changes. Investors are understanding a harsh truth. In a world where tankers are seized and oil flows are weaponized, a paper contract promising future delivery of silver is not the same as physical metal in a private vault. The counterparty risk has exploded. What good is a futures contract if the exchange is located in a jurisdiction that becomes hostile? Physical possession eliminates counterparty risk entirely. The metal does not depend on any institution's solvency or any government's cooperation. In an era where bank accounts can be frozen and capital controls can be imposed overnight, the anonymity and portability of precious metals become their most valuable attributes. Despite the $5 billion mechanical sell-off, silver has not crashed below $70. Why? Because every dip is being met with strategic buying from entities looking at 4-year geopolitical trajectories, not 4-hour charts. The Venezuelan oil crisis is part of a pattern: collapsing globalization, fractured trade relationships, and the return of great power competition. The Monroe Doctrine is being reasserted with naval force. Every nation watching is drawing the same conclusion. If the United States will seize Russian-flagged vessels, if military intervention is openly discussed, if Greenland's minerals are being targeted, then no international agreement is stable, no commodity flow is secure, no fiat currency promise is reliable. This is the safety net, built not from optimism, but from recognition of global fragmentation. Professional money is asking only one question: how much can they accumulate before the rebalancing window closes and the market refocuses on the chaos unfolding at sea? There's a facility in Shanghai that processes more silver in a single month than most Western nations mine in an entire year. The workers operate around the clock, transforming raw silver into industrial-grade products. And these products do not sit in inventory. They are pre-sold before they leave the production line. Orders come from solar manufacturers, electric vehicle producers, semiconductor fabricators, and military contractors. Every ounce is spoken for months in advance, yet the paper price just dropped 2.9% in a single day. This disconnect represents one of the most significant structural anomalies in commodity markets. While index funds liquidate $5 billion to satisfy portfolio requirements, the real economy consumes silver at a pace exceeding current mining production. The gap between production and consumption widens each quarter. This gap cannot be filled by printing more contracts. Physical silver must come from somewhere. The solar energy sector alone consumes nearly 30% of annual global silver production. This percentage is accelerating. New generation photovoltaic panels require significantly more silver per unit than previous designs. Engineers discovered that increasing silver content improves electrical conductivity by margins justifying the additional cost. As efficiency standards tighten globally, Manufacturers must use more silver per panel. This cannot be reversed through substitution. Silver remains the most conductive non-superconducting element known to science. The electric vehicle revolution creates a second industrial squeeze. The transition to solid-state battery technology requires silver-carbon composites for optimal performance. Traditional lithium-ion batteries used minimal silver. Solid-state batteries incorporate silver into the electrode structure itself. As major automakers commit to solid-state production between 2027 and 2030, industrial demand will experience a step function increase that current supply chains cannot accommodate. But industrial consumption is only half the equation. Monetary demand is driven by systematic fiat currency debasement. The gold-to-silver ratio stands at 58 to 1. Historical analysis reveals this ratio has averaged approximately 30 to 1 over the past century. The current reading suggests silver is historically undervalued by nearly a factor of 2. For this ratio to return to its historical mean, silver must rise substantially while gold remains stable. If gold stays at $4,156 and the ratio compresses to 30 to 1, silver would trade at approximately $148 per ounce. That represents potential doubling simply to achieve historical mean reversion. Geological reality further supports ratio compression. Mining data indicates silver occurs in Earth's crust at approximately 8 ounces per 1 ounce of gold, yet the price ratio stands at 58 to 1. This divergence cannot persist indefinitely. Physical inventory data contradicts paper price action. The London Bullion Market Association has reported declining inventories for 7 consecutive months. Silver leaves these facilities faster than it arrives. The metal moves from exchange vaults into private storage, west to east, from publicly reported holdings into unreported accumulation. New York COMEX warehouses show similar trends. Eligible silver stocks have declined over 20% in 6 months. This drawdown occurs while open interest remains elevated, creating potential mismatch between paper claims and physical availability. If contract holders demand physical delivery simultaneously, the exchange may face a supply squeeze forcing rapid price appreciation. Short sellers currently celebrate the mechanical dip. They view the decline as vindication, but these short positions represent coiled buying pressure. Every short sale creates a future obligation to buy. If physical silver becomes scarce, short sellers may face impossible covering scenarios. This is classic short squeeze setup. The convergence of industrial demand acceleration, monetary debasement, historical ratio, mean reversion, and physical inventory drainage creates structural foundation no rebalancing can overcome. The $5 billion liquidation erases paper positions, but creates no additional physical silver. Factories in Shanghai continue operating regardless of New York algorithms. Solar manufacturers continue ordering regardless of passive fund sales. Investors understanding the difference between price and value continue accumulating, while the mechanical storm provides artificial discount. The current price represents battleground between backward-looking paper markets and forward-looking physical reality. The trading floor of a major Wall Street bank is unusually quiet for a Thursday afternoon. Senior traders are not panicking. They watch screens with disciplined focus, like chess players who studied the board and await their opponent's inevitable mistake. These professionals understand the current moment represents one of commodity markets' rarest opportunities. A forced liquidation of a fundamentally strong asset creates a brief accumulation window before mechanical pressure exhausts itself. The mathematics are straightforward. 13% of total COMEX open interest must be liquidated over 2 weeks. This is calculated requirement based on index methodology. The majority has been front-loaded into the first 48 hours. By Monday, January 12th, the bulk completes. Algorithms execute their instructions, forced sellers exit positions. The market returns to genuine supply and demand dynamics rather than portfolio mathematics. Professional money managers use this window to accumulate at artificially depressed prices. They are not buying for tomorrow's rally. They understand structural factors supporting silver remain completely intact. Industrial demand acceleration, geopolitical resource nationalism, monetary debasement, physical inventory drainage. Index rebalancing changed zero of these fundamental drivers. It simply created temporary noise obscuring the underlying signal. The current price of $75.62 should be viewed in context. Just 48 hours ago, silver traded at $83.60. The $8 decline represents 9.6% pullback from recent highs. In a market that surged 160% over 12 months, a sub-10% correction is not a crash. It is normal technical consolidation within a powerful uptrend. Historical bull market students know these consolidations are where fortunes are made by those controlling emotions and executing strategic accumulation. The support at $75 is significant for multiple technical reasons. This represents a psychological round number where algorithmic buy orders cluster. It corresponds to the 23.6% Fibonacci retracement from the rally beginning late 2024. Technical analysts using Fibonacci ratios view this as high probability zone for trend continuation. If silver holds above $75 through remaining rebalancing, the technical setup for the next leg becomes exceptionally strong. The Relative Strength Index provides confirming signals. Daily RSI pulled back from overbought territory above 70 to sustainable level around 55. Extreme short-term momentum relieved without breaking trend structure. Weekly RSI remains firmly bullish, suggesting longer-term trend stays intact. These indicators, combined with fundamental drivers and known forced selling timeline, create risk-reward profile heavily favoring strategic buyers. But the decision matrix extends beyond technical analysis. The strategic question is not merely whether to buy silver, but how to position where physical possession may become significantly more valuable than paper exposure. Events in the North Atlantic, tanker seizures, military intervention threats, resource control pushes, all signal fracturing of the post-1945 global order. Counterparty risk becomes the dominant consideration. A futures contract is a promise, but that promise is only as reliable as the institution making it and the legal framework enforcing it. If geopolitical tensions escalate where international agreements suspend or trade disrupts, paper contracts may become difficult or impossible to settle physically. History provides examples. The Hunt Brothers Silver Corner in 1980, the London Metal Exchange nickel crisis in 2022. When push comes to shove, exchanges change rules to prevent delivery failures. Physical silver held in personal possession or secure private storage eliminates counterparty risk entirely. The metal does not depend on any institution's solvency or government's cooperation. It simply exists as tangible asset that can be transported, stored, or sold at owner's discretion. In an era where bank accounts freeze, wire transfers block, capital controls impose overnight, the anonymity and portability of precious metals become their most valuable attributes. The current dip provides an entry point $8 lower than prices available 2 days ago. For investors unable to purchase at $83, the mechanical liquidation delivered a gift, but this gift has an expiration date. Once index rebalancing concludes and forced selling evaporates, the market refocuses on factors that drove the 160% rally. Those factors have not weakened, they have intensified. The path to $100 silver is not a straight line. Markets oscillate, consolidate, shake out weak hands, and reward patience. The volatility scaring novice investors is the mechanism creating opportunity for disciplined capital. Every panic seller at $75 today will likely buy back at higher prices, having transferred their position to someone who understood the difference between mechanical noise and fundamental value. The window for making that choice is closing with each passing hour.